Hey everyone, this is Kirk here again at optionalpha.com, and in this video tutorial I want to talk about some liquidity and pricing requirements as it relates to earnings trades. So again, we're just talking about earnings trades. These are those one-day events where we're trying to take advantage of that IV drop or that IV crush that happens. And I want to go over a couple different examples tonight to show you what really good liquidity and pricing looks like, and then also a couple examples of what bad liquidity and pricing looks like. So we're going to start off tonight with actually SLB, and because we're actually making this trade right now. This is a live trade that we just made at the time of this recording, which was January 15th. And so I don't know if it's going to be a winner or not, but it's a live trade and I want to show it to you because we're trying to put our money where our mouth is here. Exactly what we preach to you guys and what we tell you and what we coach is exactly what we do. And you can see we have these little position tags right in here inside the video platform here. So you can see that these are live positions that we already have. These aren't working orders of some kind. Now, what I always say with regard to option liquidity is that first we want to see option depth. And so what option depth means is that there's a lot of depth in the underlying across a bunch of different strikes. So we want to see a lot of liquidity across a bunch of different strikes. There's no one strike that kind of dominates. And you can see on SLB here, both in volume and open interest on both sides of the market, there's a lot of liquidity and a lot of depth, meaning that there's a lot of activity at every single strike that it has. Now, some options have more activity, and those are the ones that are closer to the money. They've got a little bit more activity than others. But in general terms, there's a lot of depth and liquidity in the market. You can see it's pretty evident, especially with some of the contracts that we are dealing with have a lot more liquidity and volume today. And that was part of the reason that we chose them, though it's not everything. Now, the other thing that we talk about is pricing requirements. And pricing is kind of something that's not set in stone. There's no hard and fast guidelines for them. What we do like to see is we do like to see us getting outside of the expected move, which in this case for SLB, this was $3.34. So that's the expected move that it should be making, or somewhere inside that range, up or down. And so we like to price our strategies and select strike prices that are just outside of that expected move. Now, we can always get outside of that expected move, but then the question becomes, are we getting enough premium to make the trade worthwhile? A good rule of thumb is that you want to try to collect about 20% or more of the expected move. So you want to collect about 20% or more of this 334. And if you can do that, that's just a good rule of thumb. It's not going to say that you're going to make more money or less money. It's just a good rule of thumb, some road marker or guidepost to use as you're collecting premium. But at the same time, if you're only collecting 10 cents or 12 cents, not enough to cover commissions, it's probably not worth doing the trade. In this case, we collected about $1.09 in the trade, and from where we actually ended up making the trade, not from where it's trading right now, but we ended up collecting about $1.09 in the trade, or about $109. So it ended up being a pretty good trade. That also moved our break-even points out another $1 on either end, from 80 to 81 on the top side and 73 to 72 on the bottom side. So really good example here of great liquidity in the underlying market and really good pricing as well. The other one that we want to look at is Intel. And you can see with Intel, I'm sorry, let me just go back real quick. I know I'm jumping back and forth. The other thing is that we collected about $1.09 in premium. So $1.09 divided by the expected move, which is 3.34, means that our premium was about 32.6% of the expected move. So just to kind of round out what we talked about before, trying to collect around 20% of the expected move is what you're looking for. The other trade that we got into today, again, we got into this trade today. This is Intel, and you can see this is true trades by our position here. Instead of doing a strangle in this case, we did a straddle. And again, we liked to get outside of that expected move, which is about $1.50. So 152 is the expected move. That's what we were trying to do. We did so with our Iron Condor and collected 43 cents, which is obviously more than that 20% threshold of the expected move. So pricing-wise, it was pretty good. What I really love about Intel and why I'm going over this in this video is that it has a ton of liquidity. And you can see just how liquid these markets were. In fact, the pricing at the strike that we selected here, the short strike at 37, was about a 2 penny wide market. So you can see the bid-ask spread in this market was incredibly tight. And this is a really good thing. This is something that people really gloss over, is this idea of liquidity. But as I'll show you later, if you don't take notice of liquidity now, it can create huge slippage costs in your trades later. And slippage is not something you feel. You don't feel the effects of slippage, but it's something that can really, really dramatically affect your profit and loss at the end of the year without even knowing it. You can make really great trades, high probability of success, but if there's a lack of liquidity in the markets and you have incredibly wide bid-ask spreads, it creates really, really tough slippage to get around. And again, the same thing on the other side. You can see that these markets are pretty tight. They widened out overnight right now, but they were pretty tight today. They were around 3 pennies today and about 4 pennies here at about 34 strikes. So you can see, again, lots of liquidity. There's a very active market, 23,000 contracts, 26,000 contracts traded. And you'll notice that we tried to, stay where most of the contracts were traded. That just allowed us to get in and out of the market very, very quickly. And again, on the call side, we stayed right around where the vast majority of the contracts were traded because that was a great area to trade and it was outside of this expected move that we were looking at. So again, a really, really good example with Intel and super, super liquidity. All right, so let's look at a couple that maybe are not so good. So this one is Lennar. This is LEN. And Lennar has decent liquidity, and so it kind of meets the requirement for liquidity. There's a lot of activity here for sure. There's a lot of things going on. You can see that the at-the-money strikes have a lot of liquidity, and the markets are very deep and wide. But the problem with Lennar is that you just can't get enough premium to really make this trade worthwhile. So the expected move is about $1.23, and from where the stock closed, that means you'd have to get at least somewhere under 42 and a half, really, to say the least, and to make it worthwhile. So you're looking at about 41 and a half, 41 as far as an expected move lower. And so to sell premium for just 13 cents, which is what the 41 strikes would be, or to sell premium above the market for about 11 cents at the 44 strikes, again, it gets you outside of that expected move, but you're really not taking in enough premium to make the trade worthwhile. So hopefully that is a really clear example. Again, the liquidity in Lennar is okay. The liquidity is fine, but when you actually look at the premium that you're receiving, you're just not receiving enough premium to make the trade worthwhile. You're capturing enough premium, close to a 20% capture rate on the expected move, but it doesn't make sense enough to cover a lot of the commissions that you'd have to deal with. All right, so the other one that we wanted to look at was PNC, I believe. And so PNC is another firm that is announcing earnings tomorrow. We did not trade this. You can see there's no trades on here. Again, decent liquidity in the underlying stock. There's not bad liquidity, but it's not great liquidity at the same time. But again, the expected move here in PNC is about $2, and you can see you get outside of $2 and the options are worth about 18 cents on an $85 stock or 7 cents as you get down below the market. So it just doesn't make sense to make this type of trade because there's just not enough premium there. Liquidity is okay and you get past that hurdle, but then when it comes to pricing and premium that you're receiving, there's just nothing there to really be had. So you got to kind of scratch that one off. Now, some of the other ones that are out there, I think one of the ones that we want to look at is BIRD, I believe. Oh, no, which one is it? Hold on one second. It's BRID. Oh, or WIT. Okay, this is another one that has earnings. I'm sorry, it was WIT. So this is another one that has earnings that are being announced tomorrow. This is probably a classic example of a stock that just has no potential chance to be traded because look at the liquidity in this market. And this is incredibly low liquidity. I mean, practically no liquidity. You can see there's one contract here, the 12 and a halves that have about 1,000 open interest in contracts. But after that, there was only one contract on both sides that was traded today. It's impossible to trade this thing and make a living doing it. And really, it comes down to the fact that this liquidity, in fact, there's nobody there to trade with to begin with, but even if there was, the bid-ask spread in some of these markets is almost $45 wide. So you're losing $45 right off the bat as soon as you get into the trade just on the bid-ask spread and the slippage. And again, that's not something that you necessarily feel, but you can visually see it now. that the bid and the ask are $45 apart. That's a huge margin to cover. And for a small retail trader like you and me, it's just impossible to get that back. So you've got to focus your attention when it comes to earnings trades on really high liquidity, great pricing. It is worth your time and investment to learn how to do this right and to pick and choose the trades that are appropriate and fit those parameters, because you do it the wrong way, even if you're right in direction or implied volatility drop, you may not be able to exit. And even if you can exit in a low liquidity market, you're going to lose a bunch of money just on the slippage. So hopefully this was a really good example as we went through a couple different scenarios here with live trades that are trading right now with earnings. So the data couldn't be more fresh and realistic.